computer. Good to go?
Got it.
All right. Welcome back, Rise Seattle. This is the Rise Seattle podcast. We are the podcast that is on a mission to help Seattleites rise above the gray and live their best lives. I am Tyler Davis Jones. It has been a long time since I've been here on this podcast. And the reason for that is we took a break. Basically, COVID hit. And there wasn't a lot of activities that were taking place in Seattle. We kind of stayed home and stayed in place. And we got really, really busy on the real estate front. So busy that I ended up taking on a business partner and growing a team. And now we actually have the Rise Seattle group, which I'm very excited to introduce my business partner and good friend, Adam Hestad. Adam, how are you?
I'm doing great. I'm really excited about this, Tyler. This was always one of the things that attracted me to you and sort of your love of people and the city. And I think that's one of the things that we shared when we started dreaming and scheming about what could we do together in business. So
absolutely,
yeah. I feel it feels fun to me to be able to jump in on this with you, ride your coattails.
Well, same. You know, one of the things we talk about with our business relationship and how it actually works is, you know, I'm the helium balloon and Adam is the string, and you can't have one without the other and have a fun toy. At the end of the day, the helium balloon floats into the ether and eventually explodes, and the string is a string, and you tie them together.
Laying on the ground by myself.
Which that you definitely did not do that, but you've got some balloon tendencies. But I just think I think our partnership has been something that has been incredibly beneficial for me as I grow in my business and for my client base, and just excited for the future. So we are the Rise Seattle group. This is the Rise Seattle podcast. Funny enough, the last podcast that I recorded was actually on the market. I don't know if you remember that time, Adam, when it was like probably April, May, and everybody was like, what's going to happen? This is stressful. I actually interviewed
April,
Dr.
May,
Dan.
the beginning of the
2020 pandemic.
April, May, so 2 years ago.
Yes. April, May, 2020. And I interviewed actually Dan Hartman, Dr. Dan Hartman with the Gates Foundation. And Dan was a pulmonary doctor and ER doc. He also was heavily involved in a vaccine company and like a leader in a vaccine company, and then ultimately was working at the Gates Foundation, where he was communicating to Bill directly, here's the best way to deliver vaccine. He actually ran the vaccine delivery department. Here's the best way to deliver a vaccine to people who have pulmonary issues. So he's literally the best person to talk to. And I remember asking him, I'm like, on a scale of 1 to 10, 1 being, you know, is this thing going away in a month? And 10, is my daughter never walking into a Safeway without a mask on? And he paused and he was like, probably somewhere in between. And that hit me pretty hard, and ultimately encouraged me to really double down and focus on my business, to focus on myself, do a lot of reflection. And then the very next podcast that I posted was actually a podcast about the market. How's the market going to change? Because we had a lot of questions. I was getting a lot of questions. What's COVID going to do? Is this another housing crisis? Are we in a bubble? And funny enough, that podcast has the most listens to date of our podcast. So I think people are really interested. So fast forward, that was 2020. Fast forward to today, and we've had one of the most hyper growths of real estate that we've ever seen. And it makes sense, right? Like, we stayed home, we stayed safe. Well, immediately we went out and got a dog, and we need a backyard for our dog. And then what else did we do? We started looking, I need my own home office, right? So this apartment with my partner, you know, 1 bedroom, 1 bath is not going to work for us, that type of thing. What were you going to say, Adam?
Well, I mean, really, the definition, we've talked about this so many times, but the definition of home is starting to transform for people, right? Because it's where they work, it's where they live. We've never spent more time there. And so the importance of home, in that, you know, combined with some market forces that we can talk about a little bit today, has really made for an environment like you said. I mean, it's just, we haven't seen growth like this ever.
ever.
It's been,
And it's exactly. And there's a lot of variables that are pushing that, but a lot of it just had to do with demand of a product that there was not a lot of supply of. And so we're now in one of the most intense, that's, I guess, the best way to put it, markets that we've ever seen. I believe we had 16% growth within 1 month in Seattle, 16% growth in equity. And we're going to get in and talk about that. So the question of the day, the question that I think we were asking 2 years ago, and the question that we're asking today is there a bubble? Are we in a bubble? What is a bubble?
And does that matter? Yeah.
Yes. Does that matter? Exactly. What is a bubble? For me, I'm a millennial. When the housing crisis happened, it was 2008. I had just graduated college. I was just looking for a job, right? I didn't have any context as to whether or not I should buy a house or not buy a house. So it didn't really matter to me what was taking place. And I think a lot of our client base, they don't necessarily, you say a bubble, but you can't actually put a dollar amount to what that bubble is. And so my goal for today is just to go over a little bit of data that we dug up to say, okay, well, what is that dollar amount, and what is that, or could you write it out? Let's just say there is a bubble, because I don't have a crystal ball, right?
Right.
You don't have a crystal ball. There's a lot of key indicators that point to whether or not there's actually a bubble. One being subprime lending. We highly recommend going and watching the movie Moneyball. Or not Moneyball. That's the other one. That's the baseball one. What's the Big Short?
Big Short.
Big Short. Exactly. So go and watch that movie. I think that explains exactly what took place in that 2008 housing crisis. Dodd-Frank took care of a lot of those issues. It took care of a lot of those things that were taking place. And so we're not going to talk about what happened there and what caused it. What we are going to do is, when in doubt, zoom out. So let's just look at what the data shows a bubble was. So I'm gonna show this. Does that sound good to you? You got anything to add to that?
No, let's go.
Okay, sounds good. So I'm going to share this first graph. If you're listening on the podcast, I'm going to explain it. If you're actually watching the video, you can go to YouTube. It's Rise Seattle Group. Just search that, and you can actually see the YouTube. So can you see this okay? You can just see this one?
I can only see a part of it. Yeah.
Okay, good. That's what I want. So this is a piece of data that is from December 2006, and it goes into basically February 2012. Actually,
showing
probably February.
Median home prices.
Correct. Yes.
Like a 3-bedroom home in Seattle. Basically,
correct.
We just chose a subset of data, right?
Correct. So if you're looking for a 3-bedroom, most of my clients are looking for a 3-bedroom, 2-bath, 1,900 square foot, great house, right? Usually it's about a 1940s to a 1970s house, and they just want it to get into this crazy market. If you were to buy one of those houses, let's just take probably around June or so. Would you say? I think that's probably June of 2007. The median home price would be a little over $500,000, so $530,000. Okay. Now, if you fast forward to 2012, because in 2008, City of Seattle specifically didn't really experience much of a decrease. In fact, I think the median home price for the City of Seattle in 2008 was $532,500. The median home price, this was actually May of 2007, was $495,000. So there was an uptick in the purchase price and the median home price for a 3-bedroom, 2-bath, 1,900 square foot house. Okay.
Yeah.
So
the Seattle market lagged the national average.
Correct.
By 6 months or so. Yeah.
Exactly. So, nationally, yes, we were experiencing quite a bit of turmoil, but locally, it was basically just kind of a shift to the right. In 2012, that was kind of the bottom of the market. That same house, that 3-bedroom, 2-bathroom, 1,900 square foot house in Seattle would have cost you $432,350. So 432. So it dropped $100,000, which seems like a lot, right? Especially if you purchased in 2008 at 535. Well, all of a sudden you're going, my house is worth $100,000 less than I paid for it. Now, here's the interesting part. So I'm going to stop sharing this. So you're at $432,000 at the bottom of the market. Now, let's look at, had you held on to that particular property, if you would have held on to it, you would have been looking at a gain in 2015, which is 2015 is actually when I purchased my house. So that's the reason it's interesting to me. You would have had a gain of, it would have gone from $432,000 to $626,000. That's December 2015. Fast forward to today, in February of 2020, we would have gone from $626,000 to $884,000. And in 1 month, and I had said this previously, in 1 month, we've actually seen a 16% increase for a 3-bedroom, 2-bath, 1,900 square foot home. We've seen an increase from $884,000 to $1,022,000. So literally this trajectory, it's all about timing in the market. So when you say, is there a bubble? Well, the question is, how long are you going to stay in that house? Because if you're going to stay in that house, if you can afford that payment for, let's say, 10 years, right? If you can afford the payment from 2012 until 2022, you're fine. It's totally fine, because the trajectory at which the market is moving is up and to the right. Not always, right? When we look at local Seattle Times, home equities have dropped $30,000 or whatever they're trying to do to like create some type of story. When you look at those times, yes, absolutely, you've lost theoretically $75,000-$100,000 in equity. But if you project it over time, it's getting more and more and more expensive, and that has to do with inflation and a couple of other things. We will talk about inflation on a different episode. So
well, and I think we always talk about, Tyler, right? Like, people, we live in the day-to-day payment of a home purchase, right? Not in the purchase price. So, I tell clients, well, you'd spend $2 million on that house if you were borrowing money at 1%, because the payment would be in line with what you can do, right? So people, while we think we're concerned about purchase price, I think that thing that you show, the chart that you showed showing a purchase price climbing up and up and up and up, and people still buying homes, they aren't concerned so much about purchase price. They're concerned about the payment that they have every month. And so these artificially low, or I don't even know if you can say artificial anymore, low interest rates playing into this market make the payments still manageable and reasonable for a lot of buyers in today's market, And so I think, and I love that saying too. I will say that, when we talk about time in the market becomes more important than timing the market, because, I think there are very few people who can time the market, and there's some people who got lucky, and that's good for them. But people who were able to ride that out have seen quite an appreciation in terms of the value of their home if they bought in 08. Like, they wrote it down. It didn't feel good in the moment, but they could do it. They stuck with it, and today they've got a home that's worth twice as much as when they bought it originally.
Yeah, I think I actually looked at the percentages of what that increase would be. And again, just using my numbers specifically, the loss from 2007 to 2008, or really 2007 to 2012, was about 21% for that specific style of house.
That
exactly, that 3-bedroom, 2-bath, 1,900 square foot house, give or take a few square feet, lost about 21% in equity. It gained, again, starting from 2007 and up, it actually gained 206%. 206 from 2007, meaning if you adjust for what it dropped, which was 30.6%, it actually gained 176%. So had you just wrote it out right? This people talk about investing in the stock market. Had you invested in the Great Depression, right before, you would
Right.
your money would be just astronomically more well off.
Right.
It's about timing in the market, time in the market, not timing of the market. So if you're currently looking, I would not get freaked out. If you have the money and you feel comfortable with the payment for the next 10 years or so, it's I say buy. I say buy.
Yeah.
And I'm even buying. I'm literally buying. I'm writing on a
Yeah.
house today.
Yeah. We were talking about it this morning, right?
Yes, yes. So I'm not trying to be like, hey, please let me be your real estate agent. I'm literally this morning, after we get off of this podcast, I'm going to write on a house because I believe this message so much. So I'm putting my money where my mouth is. All right, Adam, you had some other data that you wanted to kind of talk about just
Well, I
as
think
far as the current state.
yeah, I think I liked your, like big picture, like we see this dip and we see this climb. And, we talked about even copying and pasting that. Like we'll see another dip and then we'll probably see another climb. And if you look back further than 2007, we've seen that in the market before. None of this is new. And we're not here saying there won't be another dip. But I think we're getting questions from our buyers to say, is it okay to buy? I feel uncertain, and so we're just trying to bring some understanding to what's going on in the market. And yeah, I will share a little bit of data um, with us too. Tyler, this is one of our favorite tools. We use this Altos data a lot because I think it tells data used correctly, right, tells a good story. And so the basics of what we're seeing today is we're seeing a very simple economic principle, right? Supply versus demand and what that's doing to pricing. And this is an inventory chart of all Seattle single family homes over the last 3 years. Very clear picture of kind of what's been going on, where you see the seasonal cycles up and down, but you see this overall trend from here. This is 3 years ago to date, right? And this is 3 years ago, or this is today. And you see this downward trend of inventory, where our belief currently is that we're in a new cycle of inventory. There's no catching up on inventory right now. Inventory is going to remain low. And so we're moving into a new kind of market where this type of pressure is going to continue. In fact, most interesting to me, if you pull up the 90-day average and you look in January, we always see inventory start to pick up again. But what's really interesting is if you look at the last 2 weeks, it peaked out and it's already, very, very small, but it's started to drop. And what's interesting about this number than where you get in other places is this number accounts for homes on the market minus homes taken off the market because of purchase prices. So this is the number of homes that are available on average on a 7-day cycle, right? And
yeah.
We're just seeing demand outpace supply, and supply isn't catching up. Go ahead.
Well, I was going to say, I think back to my economics 101 class, my freshman year, and that experience taught me that when there's less supply and more demand, prices increase. And so,
yeah, well, let's look at that, right? Let's look at median list price in Seattle. And I think this is where taking away the noise of the 7-day average and looking at a 90-day average, where in those 3 years, this is reverse of inventory. Inventory started up here and you draw a line down to here. This is the exact opposite. Median list price starts low and it just keeps moving higher. And it's, again, supply, demand. We've got interest rates. We've got a very robust economy. And we've got people coming in paying, getting real loans, 20%, 30% down to buy these homes, even the more median price homes at 900,000. Our clients are putting, a few are putting 10 or 15% down, but many are putting 20, 30, 40% down, even on these, this level of home. And, it's meaningful. It means people have the money to actually buy these homes. It's not like 2007, when if you could fog a mirror, you could get a loan and it didn't matter. I mean, that's what caused the pain of '08 to 12 for people.
Yeah.
This economy has been built a little bit differently, it appears.
Yeah, absolutely. One thing that would probably be a good thing to talk about too, Adam. I feel like you have a good way of communicating this is, we're not, whenever we do start to see the peak of these markets, we start to see the list price catch up with the sold price, right?
Yeah.
And we're starting to actually see that. Interestingly enough, this house, the reason I'm even writing on it is because the list price is starting to catch up to the sold price. So what does that mean? It means that there's either less or no multiple offers. It means that offers are not going over asking price, or if they are, it's not by much, right?
Mm.
Or it means that they're going past their offer review date and they're actually not getting any offers at all. So there are cycles to markets. Markets will start to taper off. And when we start to see that taper, it's actually a really good sign. It means that we're not going to be growing at 16% month over month, which is not healthy, right? It's not a healthy type of growth by any means.
No.
At some
It's
point, there's a
unsustainable.
ceiling. Exactly.
Yeah.
So.
Yeah, I think we will over the next 6 to 8 weeks. I think that gap between list price and the final sales price will start to lessen overall in the market. I mean, I think we're going to see a lot of variance in the market where we're going to see some continue to sell way over list price, and we're going to see some that sell at list price or below, and we're going to start to see those averages come down. It doesn't mean that paying over list price isn't okay. It might be that home is actually more valuable to you as a buyer than other homes in the market, right? But like we're going to see that variance start to enter in, and like you said, we're encouraging you. You've been on the phone calling some of your buyers today, saying, "Hey, we think we see an opportunity in the next 6 to 8 weeks.
Yeah.
Let's re up our search and be smart." We've got a principle of trying to keep the client at the center of this. Like we want you to make good decisions, but also there may be an opportunity here where the market pauses just a little bit, or just it levels out a little bit, not even pausing,
Sure.
but it just levels out a little bit.
Well, and I the wise words of Warren Buffett, get greedy when others are fearful, and fearful when others are greedy. And when markets pause, that is when opportunity happens. And I've personally been benefited from that just by having the courage. This is another operating principle of ours, is to live with courage. So if you have a dream and you're wanting to go after that dream and a market shifts in some capacity, it's not the time to pump the brakes and follow the masses. It's time to really reconsider and say, is this something I need to do? Could we potentially take advantage of a market where everyone's running the opposite way, but we're running towards the fire, so to speak? So,
yeah.
Awesome.
And
well,
I
very
think
cool.
the last thing, and we can wrap this up, but as that definition of home has changed, that also helps. We're advisors for people who buy their homes, right? There's a difference between buying just an investment, but also buying a home. And I think that's something that we try to balance. We try to help people make really good, wise financial decisions. And we also try to help people make decisions that will serve them and their people over time. I think that's why we love what we do, right? It's not just the numbers. It's about who are you and who do you want to become in your life. I mean, we've got our deal, right? Like dream big and live your best life. Like we believe that when you're in your home, it's where you get to dream your dreams and you get to then go out from home and live your best life. We hope, right? We all have our ups and downs, but it doesn't mean it all has to be good. It just means that is from where we launch, and it's why homes are so important. It's why they really are key to that's why it's part of the American dream, and I think that's the privilege that we have to enter into that with people. And we try to do that with discernment and wisdom and helping people make those types of decisions, and why timing in the market is more important than timing the market itself.
That's right. I love that. Excellent. So what did we learn today? We learned that time in the market is far superior to timing of the market. We learned if you can pay, you live in the payment, not the purchase price. So if you can pay that payment, that monthly payment for the next 10 years, and you can do that comfortably, you're in the right place. It's okay to potentially make that decision. We learned that we can't predict what markets do, but markets always go up and to the right based off of historical data, right? These are all really good key takeaways. I think if you're on the fence as a buyer, it can motivate you to potentially jump. And then we also learned, last but not least, is to when things get a little scary and people start to back away, it's when opportunity actually arises for you to jump in and maybe take advantage of that. Yeah. Don't follow the masses. You know, it's a smarter way to invest. So thank you so much. I'm excited to get the podcast back up and running. I do think it's going to be really exciting this year. We're going to be interviewing again. Our phrase is, you know, our mission at Rise Seattle Podcast. Our mission is to help Seattleites rise above the gray and live their best lives, to dream big as well. And we just want to help you. We want to bring content your way that's going to help you as an individual live your best possible life. So that's financial, that's emotional, that's physical, that's spiritual. All of these aspects we're trying to bring to the podcast with the hope of elevating you and making your life better if you implement these key tactics. So thank you for listening. Adam, you're beautiful. I love you, man. I'm glad you're here on the journey with me and with us all. And thanks for listening. If you found this helpful, please send it out to your friends. Because we're trying to provide valuable assets to people rather than, like, you know, the headline from whatever news source that's going to try to freak you out about what's happening in the future because they can't predict it. So anyways, any last words, Adam, of wisdom?
No, it was great. Thanks, Tyler. I'm excited to be on this journey. It's going to be awesome.
Yeah, me too. Sounds good. All right. We will see you back here on the next episode. We'll be discussing inflation. How much is your dollar losing? How much has it lost since the beginning of the dollar? What's your dollar worth and how is inflation impacting you? So make sure to come back for that. All right. Talk to you soon, Seattle. Thanks.